Good morning. Thank you all for being here today in this analytical corner titled Gulf Corporation Council Growth and Diversification. My name is Noha El-Gabali. I work in the communications department here at the IMF, and I'll be your moderator. Before we start, if I can ask you to please silence your phones. After that, our presenters, Wei-Ning Chin and Yevgenia Kornioko, will come up to the stage. They will present for about 10 minutes. After that, we will open the floor for a 15-minute Q&A. Thank you, and please welcome my presenters, my colleagues and presenters for today.
Good morning, everyone, and thank you for being here today. I am Yevgenia Kornienko, a senior economist in the Middle East and Central Asia Department.
I'm Wei-Ning Chin, an economist in the Asia-Pacific Department.
Today, we invite you on a journey in which Gulf Cooperation Council countries, or GCC countries, are transforming their economies to thrive in future sustainable and smart world. Historically, these countries relied on hydrocarbon for growth. Now, the region faces challenges of diversifying away from oil to reduce risk associated with highly volatile oil prices and global decarbonization efforts.
But the winds of change are blowing. The GCC nations have embarked on wide-ranging economic reforms and ambitious economic strategies to diversify their economies, enhance productivity, and prepare for energy transition. The transformation is not just a strategic choice, but a necessity for ensuring sustainable growth for future generations. More importantly, this transformation can have a broader implications. By diversifying their own economies, the GCC nations can help mitigate the risk of global climate change, provide jobs for millions of people in the region, and contribute to global and regional economic integration.
However, despite progress, illustrated by the two upward lines on the slide for positive trends in non-hydrocarbon GDP and export shares, challenges remain in achieving higher level of productivity in foreign investments, addressing skills mismatch, youth unemployment, and foster private sector growth and development. The burning question is, how can the GCC countries achieve their ambitious objective of higher diversification?
One key approach is through investment, both foreign direct investment and strategic partnership with international investors. These collaborations can facilitate knowledge sharing and creation, technology transfer, and industrial complementarities. In particular, GCC Sovereign Wealth Fund can play a pivotal role here. Managing over $4 trillion of US dollars in assets, they are transforming from merely just financial saving instruments to active participants in the GCC economic transformation. Recently, sovereign wealth funds in GCC have increasingly invested in advanced technology and clean energy, although the majority of their investment have remained in traditional industries and infrastructure. Using comprehensive deal and project-level data over more than 20 years, our research delves deep into GCC investment, their impact on non-hydrocarbon GDP growth and economic diversification, and the role played by sovereign wealth fund.
Our research shows promising trends. Foreign investment into the GCC are growing, and in 2023, they were almost 4 times of a decade ago larger. Also, this is still relatively low compared to other countries at similar level of economic development. The positive trend reflects both global factors, such as international investors seeking higher returns in GCC, and GCC countries' efforts to attract foreign investments. Such efforts include reforms to liberalize foreign investment regulations and foster a more business-friendly economic environment. GCC reforms led not only to the higher levels of foreign investments into the GCC, but also to the change in the sectoral composition of these investments. As we show on the slide, Investment into the marketable services sectors had gained prominence after the COVID or pandemic, receiving about 70% of foreign investments in industries like transportation and logistics, information and communications technology, health, hospitality, and professional and business services.
Not only are these countries attracting investment from abroad, they are also increasing their investment to other countries and establishing strategic partnership with international investors. The total outward of investment from GCC to others have almost doubled since 2010, reaching about 8% of total GCC GDP in 2023. However, there are large differences from country to country. This upward trend has been mainly driven by Saudi Arabia and UAE. Both have been scaling up their outward investment significantly since 2018, but that in other GCC economies have remained relatively stable. And similar to inward investment, GCC countries have been increasingly invested in foreign marketable services, accounting for more than half of the total outward investment. And these services include knowledge-intensive services, for example, the ICT sector, which could be a vital conduit for knowledge sharing, technology transfer, and innovation. And moreover, sovereign wealth funds have been the main vehicle for this upward trend, driving more than 80% of the total value of the outward investment in our database.
So, what are the economic impacts of these investments and partnerships on GCC growth? Our analysis indicates that a 1% of GDP increase in foreign investments into the GCC corresponds to above 1 percentage point increase in real non-hydrocarbon GDP growth over 5 years, as we show on the slide with red line at the top. This impact is nearly 3 times larger than that of domestic investments in our database. We find that a 1% increase of domestic investments corresponds to about 0.4 percentage point increase in real non-hydrocarbon GDP growth over 5 years in GDP, as we show by the green line on the slide. This means that foreign investments in GCC lead to far more growth in non-hydrocarbon sectors than domestic investments. How do we explain it? The smaller impact of domestic investment could be explained, for example, by the differences in the targeted sectors. Sovereign wealth funds may invest more in large-scale infrastructure projects with longer-term growth impacts and potentially less knowledge and technology transfer compared to foreign investments.
Another strategic shift that is gaining momentum in GCC recently is their increasing focus on investment in renewable energy and low-carbon technology. The GCC countries have continued to build their renewable energy generation capacity both domestically and through cross-border investment. In particular, as shown on the slide, outward green investment have contributed almost half of the total committed capital of total outward investment from GCC. As found in many studies, these green investments have significant multipliers on non-hydrocarbon GDP growth, creating jobs and enhancing economic diversification. Moreover, this investment in renewable energy has been mainly driven by sovereign wealth funds in the GCC, which further underscores their crucial role in transforming the GCC economies towards a greener future.
To conclude, our findings underscore the crucial role of both foreign investments and sovereign wealth fund investments for non-hydrocarbon GDP growth and economic diversification in GCC countries. First, because foreign investment have a significantly larger impact on GCC non-hydrocarbon growth, it is important to focus on attracting foreign investments and partnerships into the GCC to enhance economic diversification. This means that GCC countries need to continue working on reforms to create a more level playing field, foster a more transparent and competitive business environment, and further strengthen their institutions. Second, Domestic investments need to be more effective. Reforms that enhance private sector development, improve public investment management, as well as minimize crowding out of private investments and facilitate crowding in foreign investments, can help to create a higher impact of domestic investments on growth. Imagine a future where these nations are recognized not merely for their oil reserves, but for their innovations in technology and renewable energy. Thank you.
Thank you, Wayne and Yevgenia, for this great presentation. Now we'll take questions from the floor. If anyone has a question, please raise your hand. Somebody will come to you with a microphone, and please state your name and your affiliation before you ask the question. Anybody have a question? I can ask the first question. Do you see any impacts of geo-economic fragmentation on GCC cross-border investments?
Thank you for the question, Oha. Maybe I can take this question first. So we haven't really looked at the impact of geo-economic fragmentation on GCC cross-border investment because this is now the main focus of our research. But I can give a bit colors in terms of the geographical composition of GCC inward and outward investment so that can speak a little bit to the geographical allocation. So in terms of inward investment, we see that the inward investment from GCC, its own region, is still the main bulk of the total inward investment. However, we do see there's some diversification in terms of geographical allocation. For example, we see there are GCC countries are sourcing more inward investment from Asia-Pacific department and region and European region. And in terms of outward investment, we see there's an increasing trend in terms of GCC outward investment into West Hemisphere region, and which is likely driven by the United States, and this could well reflect the GCC investment that is seeking for higher returns in the high technology sector, as mentioned in our paper.
Thank you. Any questions? I don't see any questions. Well, thank you all for being here today. Before we close, I just wanted to ask the two of you, what is it that you want the audience and us to leave with today, to remember from this presentation?
At the end, I would like to emphasize that in GCC, it is important to continue focusing on reforms, and the time for action is now. By embracing foreign investments, leveraging resources of sovereign wealth funds, and also fostering private sector growth and development, these countries have the opportunity not only to diversify their economies away from oil, but also to become global leaders in innovation and technology, which is very much in line with their strategies and visions.
Thank you so much. All right, well, thank you all very much for being here today. Remember, there's a session that will start in about 10 minutes. If you want to save your seat, please stay there because we will be able to hold the seats for you. Thank you and have a great day. Thank you.